Okay, here are some solved examples for chapter 4. So please make sure that you work them out yourself first, and then you can see the next explanations on the next page. And I also have a YouTube video, which is this one, which is basically explaining how this works. Okay. So the first thing we're going to work is to basically see how we can calculate the net asset value per share. And we are going to use an actual mutual fund, that's the Vanguard Index 500 fund. And we'll see how we can calculate the NAV per share for the Vanguard Index 500 fund. Okay, here is something that is called the report to the shareholders, the certified shareholder report. So that is called the NCSR, certified shareholder report. And this is required to be filed by all mutual funds with the SEC. So you can get this from the Edgar, and I have the URL on the Excel home on the one of the Excel cells. So this is as of December 31, that's the fiscal year end, but this reporting period is for the first half of June 2020. So they have to provide this on a semi-annual basis to their investors. So this is for the Vanguard 500 Index Fund, semi-annual report as of June 30th, 2020. Okay. So the first thing, so they'll give you some information about their expenses and stuff like that, okay? So you can read that, that's useful to know. And then they will give you some estimate of what the return would have been and how much expenses you would have paid. So it's supposed to be giving the investors an easy to understand way to figure out, hey, I invested in this fund, how much did it cost me? Okay. They'll give you some asset allocation. So they'll tell you how their assets have been allocated. So this is a stock index fund. So pretty much all of the investments is in common stocks. But now this is giving you the different sectors, the S&P sectors in which it has investment. And this should very closely mirror what is there in the actual index because this is an index fund. Okay. So one of the things that's interesting is they will provide what is called the schedule of investments. So they're going to give you literally all the shares that they hold. Okay, you can see the names and how many shares they hold and what is the market value of all of those shares. Okay. And this is the S&P 500 index fund. So, and you can see common stocks is 99.6%. So that means this is virtually 100% invested in common stocks. Okay, and they will give you all of the investments that they have in the fund. So this is required by law. So every open-end mutual fund has to provide this. Okay, and you can see it's a 500 index fund, so it's going to have 500 stocks in it, right? So you can see it's going to go over a few pages. Okay, and then they will have some money market cash so that if people want to redeem their investments, they'll be able to give them the cash. So they don't have to liquidate the portfolio. Okay, so that's the basic idea. Okay, so you can see the statement of assets and liabilities. So here's where the NAV will be calculated. So you'll see they will list all of the assets that they have, how much they have in securities, in cash, and cash collateral, and so on. So all of the total assets, they add up to about 536 billion. So the first thing you should note is these are all amounts in 1000s. Right? So this is so many thousands, so many millions, so many billions. So it is $536 billion of assets. Then you go to the liabilities. So they have some liabilities which are roughly about 3 billion. So the difference between total assets and liabilities, so that is now the net assets that's available to all the shareholders, 533 billion. Okay, so we know that it has total assets of 536 billion, liabilities of about 3, so the net assets are roughly 533 billion. Okay, so what you can see is that this fund now has 4 asset classes. All right, it has 4 classes: the investor shares, admiral shares, the ETF shares, and the institutional shares. So this now gives you the total assets out of this, total net assets, that's attributable to each of those classes. So the investor shares, there are so many shares outstanding and they have claims on so many dollars of net assets. Keep in mind these are all in thousands, so this is 4 billion. So divide this total net assets attributable to this class by the number of shares and you will get the NAV. You can do the same thing for different asset classes. Now, the one thing that you should notice is all the net asset values per share, they are not all the same. And that is because their cost structure is going to be different. Maybe the different classes started on different days. So they will all have different starting points. Okay. But their return movements will be highly correlated, even though the net asset value per share might be different. So this is basically how you can calculate the NAV. Identify the total net assets, net of liabilities, divided by the number of shares outstanding, and you will get the NAV per share, net asset value per share. Okay, so now let's go ahead and do problem 2. So now you have a mutual fund which has an offering price of 12.30 per share. So an offering price means this is the price that the investor has to pay. But this now has a load of 5%. So what this means is you're going to pay $12.30 per share, but 5% out of that is going to go as a load to the broker. So you're going to lose 5% of that, and only the balance 95% will be invested in the assets, in the actual mutual fund. So your net asset value is basically $12.30 times 0.95, which should be $11.69. So what this basically is telling us is that I'm going to pay 5% of this in my investment amount. I'm going to pay that as a load, which is 61 cents. So $12.3 minus 61 cents, the NAV is 1169. So now let's go ahead and look at problem number 3. So you have a fund which starts off the year with a NAV of 1250, and by the end of the year, the NAV has come down a little bit. $12.10. Now it is paying some distribution, so you can think of it as an income return or a capital gain dividends. So these are all examples of different types of cash flow that the mutual funds will pay off. You can see them on the group project that you're doing. Okay, and the total distributions is $1.50. So the question is asking us to calculate the return to the investor. So now the investor has invested $12.50. It's lost 40 cents in value, but you got $1.50 in terms of distribution. So your total gain is $1.50 minus 40 cents. So that's $1.10 on an investment of $12.50 will give you 8.8%. So that's basically what we have. So you lost 40 cents on the price, you received distributions of $1.50. So your total income that you got, or total gain that you got, the amount of money that you made is $1.10. So that on an initial investment of 12.5 is 8.8%. Okay. So those were examples of open-end mutual funds, which are basically open-end in the sense that investors can buy and sell them at the end of the day at whatever is the net asset value. But a closed-end fund trades more like a common stock, and the price at which you buy can be higher or lower than the NAV. So in this case, we have a closed-end fund which starts the year with a net asset value of $12. By the end of the year, the NAV has gone to $12.10. So that means the assets have appreciated in value by 10 cents. At the beginning of the year, the fund was selling at a 2% premium, so the price at which you could buy the fund was at a 2% premium to this. By the end of the year, the fund was selling at a 7% discount to this net asset value. So it is 7% lower than this. Now, if you received distributions of $1.50, what return would an investor get? Now keep in mind, this is a closed-end fund, so that means this is trading like a stock on the exchange. That means you're going to be buying and selling at whatever is the closed-end fund price, not the NAV. If it's an open-end fund, like in the earlier example, then your transactions will be at the NAV. But if it's a closed-end fund, your transactions are going to be at the price. So you're going to be buying it at a price which is 2% higher because it's a 2% premium. So your price is going to be $12 times 1.02. So that is $12.24. Now at the end of the year, it's trading at $12.10 minus the 7% discount. So I can go ahead and calculate the end of the year price as $12.10 times 0.93 because there's a 7% discount. So that is $11.25. So what is the investor return? So I bought it at $12.24. I sold it at $11.25. So I lost 99 cents, but I gained $1.50. So my total gain is 51 cents on an investment of $12.24. So my return is 4.17%. If you want to calculate the actual return that the assets have earned, so now we can see the assets have gained 10 cents here plus $1.50. So the total gain is $1.60 on an initial base of 12. So $1.60 on a base of 12 means 13.33%. So in this case, the investor's return is much worse than what the assets have given out. And that is because it used to be trading at a premium when you bought it, but now it's trading at a discount. So you're losing value.